Okay, today we're going to look at making money in the stock market. So, how would I take, say, $1 and make $5? Or if I took $5, could I make $10? Could I make $20? Could I take $1 and make $20? Or $50 or $100? If I had money, which a lot of people say, we can make more money with the money we have. So, one way to make money with your money is to buy stock. So, let's look at what is a stock, why buy a stock, how do I make money, and what is the risk. So, let's explain how a stock basically works. Now, if you buy a stock, you're basically owning part of a company. Today, we're going to look at how that works. So, let's say you're like, I love Coca Cola. I would like to invest in Coke or Apple or Twitter or Facebook or GE or whatever. Now, think of it like a bunch of little puzzle pieces. Now, you see here, ding, 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 there's a Coke puzzle. So, Coke breaks itself in a bunch of little baby pieces. So, why would it do that? Well, let's say a company needs money to grow. Okay? So, they want to grow their money. Well, what they can do is they can break themselves up into little pieces called a share. So that's what Coke did. It broke itself up. Now, the third one there, you can see, that's two, they broke themselves up. Then what they did is they sold some of these shares to the public. That is called an IPO. Now, IPO, initial public offering, in 1919, what they did is they broke themselves up basically into 600,000 shares. Now, they do more, but let's just say they took 600,000 shares. They wanted to sell them at $40 each. So they made $24 million. So back in 1919, they took their $24 million and then they started to grow their company. Now, obviously, over time has changed. So let's say you took $40. Now, Coke is averaged 14% yearly growth record. So their rate of yearly growth rate is 14%. If you bought one share back in 1919, you'd have $13 million today. Yes, that is $13 million. Of course, people born in 1919 would be 102 or 3 years old, so kind of a moot point. But you understand that this is what companies do. Okay? So I've had companies before that I bought and sold. If I wanted to take more money and I want to invest my money, I can go public. And basically that's how a stock works. Okay? So they break themselves up into a bunch of little parts. Let's say a million or 2 million or 20 million little pieces. They put a dollar amount on them. They put out a certain amount of shares and then they trade them in the market. People buy and sell them. So why would we buy stock? Like, what good does it do? Well, first of all, spending all the money you earn is a bad idea because our work is not always guaranteed, right? So if you spend all the money you earn and then all of a sudden you stop making money, you lose your job, you might have a problem because now you have no money left, right? Now, saving money in a sense is a bad idea because just saving money, your purchasing power decreases because of inflation. So if I took all my money here and I held on to it right here, let's go way over here. Woohoo! I took all my money and I put it in my room. Well, if I held it for 5 or 10 years, now my $500 won't buy the same amount of goods because now things are more expensive. So you're kind of actually losing money. If you're saving money for a purpose, like going on a trip, then it's good. Now, investing is basically a chance to grow your money. Investing will grow your money. So, basically, when you buy a stock, you own, bam, a real piece of a real company. You get to vote. Hey, you ever like voting? A lot of stocks, you have voting rights. So, the more stocks you have, the more votes you get, basically. And you get a say in you're a shareholder, right? So you're like part owner. They're easy to buy and sell today. Bam, easy to buy and sell. Ameritrade, Fidelity. You can look at our how to buy stocks and talk about the different companies out there. Purchase cost today is free, basically. You can buy and sell stocks free. No more commissions, no more trade costs, that kind of thing. So it's good. Now, one way you make money is they go up and down. Now, it is good that they go up and down because you can make money when they go up and you can make money when they go down. That's the good thing about it, right? And stock can pay a regular dividend, which we'll talk about. Meaning they're going to pay you every quarter or every 3 months or every 6 months. Every company is a little different. If they pay a dividend, they're going to give you money, right? So maybe Coke will give you $1.44 every year or whatever the amount is, okay? They're going to pay you a dividend, okay? So that's how basically you make money. Why do you buy a stock? Well, the prices go up and down. Hopefully, they go up when you buy them lower, right? You don't want them to go down because then you will lose money. We're going to talk about the risk in stocks right down here when we get to the risks. So how do you make money? How does it work, right? Like they say making money in stocks. Basically, you can buy low and sell high. Buy it low, buy it at $1. We'll call that a penny stock. Anything under $5 is called a penny stock. 1, 2, 3, 4, 5. So because it's a cheaper stock, price-wise, right? It's only $1. So most stocks, they run like $10, $20 a share, right? So if you buy a stock at $20, let's say you bought, I don't know, Apple a long time ago. When I first started trading, it was $8 a share, Apple. Then it went up, it's hundreds right now. I bought it at 20, and then let's say a year later, it's now $50 a share. So if I buy it and I sell it, I buy it at 20, bink. If I sell it, I make money, right? So if it starts at $20, bam, and then a couple years later, it goes up to 50. You're like, wow, they're going to make money. Now, if you bought it at 50 and then you panic and freak out, sell it at 20, then you lose money. Or you can give dividends. Now, again, dividends just means every month they're like, okay, here's $1. Okay, next month, here's $1. Next month, here's $1. Now, some stocks do it monthly, dividends. Some do quarterly. Some do like twice a year. And some there's like special dividends. They give like a bunch of money every year. So every stock's a little different. That pays a dividend. So let's look at how you make money in that. So you buy a stock that pays a dividend, 1. Okay. Now, back to this one here, buying a stocks that pay a dividend. We're going to talk about keeping your dividend money or making payments and buying more stock. Now, a DRIP is basically a dividend reinvestment plan. So if a company gives you $1, instead of keeping the dollar, now you'd keep the money, right? You can buy more stock, basically for free. So every time they give you money, so every quarter they're giving you money, you keep buying more and more stock. Now this is the area of what we call compound interest there. The longer you hold, the longer the compound interest. It's a magical formula. So let's take a look at this. This is VF Corporation, okay? Now, let's say you started with $10,000 investment. Your beginning shares were $277.39. You see that? Okay? So you buy them. So what's going to happen is you take your 10,000, okay, and you buy your 277 shares. Now, what they're going to do is they're going to give you a dividend. So let's say they're giving you $1.01, okay? Okay? And what's going to happen on the dividend, now notice here that sometimes they go up. So maybe every year it increases. So it starts at $1, but then next year it goes up 4%, which is $1.05. Right? Then it goes up 5%, which is $1.10. Now, this baby right here in 2006 increased its dividend by 76%. So now they're giving you $1.94, right? Every year. So let's say you take this money. Now, if you take the money and keep it, then you get your $1.94. If you have 100 shares, you get $194. If you have 1,000 shares, right, then you would get $1,094. If you have 1,000,000 shares, right, you'd get $1.94 million, right? Because for every share, you get $1.94. Now, so the dividend growth rate goes up. That's a good sign. Now, VF Corp did very good. Okay, so the average growth rate over 10 years. So They grew their dividend, not the stock price, but just the dividend grew at 13.6%. Okay, so you got it. Now, EPS, earnings per share payout. This is a very important figure. Now, if I am giving out $1, but I'm only making 80 cents, that means that the company is probably borrowing money to pay you. Now, this 28% means that only 20% of their earnings per share went to the dividend. So you noticed here that it's changed over time. And you notice that it's 28, 24, you go 24, 40, 41. Now, even at 41%, that means 41% of the profit, the earnings per share, they're giving back in dividend. That's pretty good because they're keeping the other 59%. So that's good. Now, what's going to happen is, let's say you start increasing your dividends, okay? So, ready? Let's go back again. Ready? So, if you got an extra share, you would go from 277. Now, the next year, you would have 284. Why? Well, because they gave you a dividend. Because you have 277 shares, they gave you $284. You took that $284 and you bought more shares. Sorry, right there. So now you got 284. So you took your money. Okay, you took the money that you got. So notice, 284 the first year, 300 the next year, 323 the next year, 585 the next year. You notice their dividends keep going up. Why? Because they're growing their dividends. And now your share price is going up because you have more shares. So if the share price goes up and your shares go up, you're making more and more money. Now notice the key here. The more shares you have, the more dividends you get. So now in 2006, I took $585. Now I have 304 shares. If I waited longer in 2010, I have 346 shares. Now remember, I started with 277. Now I have 346 shares because I keep buying shares with my dividend. Doesn't cost me a penny. I paid nothing. All I paid was my initial $10,000. Okay? So you got it. So what happens here is over 10 years, on my 277 initial shares, the ones I bought, I received $6,560 in dividends. If I kept that money, I would have $6,560, but I'd only have 277 shares. I wouldn't have 362 shares, right? Because I keep buying them. Now, they compound. Every year I keep getting more shares. More shares and more dividends means more money, right? Now, your total investment plus your appreciation means the stock price going up and you're reinvesting your dividends is $61,183 over 10 years. So basically, you made on the total that $51,000 because now the total is 61, but you put in 10,000 in the beginning. That's actually pretty good. Now, the total annualized year over year or return on your reinvestments, basically, your return on your reinvestment was 19%. Every year you're making 19%. 19% is huge, okay? Now, the S&P was 7.6% if you just basically did the same thing, right? So what you're looking at here is your $10,000. Let's just say this is $10,000. At the end of 10 years, then you had 6 of these $1,000 bills, right? So you had 6 of these, right? Basically, the way it works is this. If you buy it at let's say, you buy a stock at $10 and you hold it and then you sell it at $50, you made $40. You paid $10, but you got $50 back. So you minus 50 minus 10, you made $40. But if you have dividends, you could keep the money that they paid you in dividends. Let's say the dividends were $50. But keep buying your shares for free through a drip. Now, let's see. My Ameritrade has a drip plan for free. My Fidelity had a drip plan. My E-Trade had a drip plan. I don't know if my other ones I had a drip plan. Not all of them have this. Drip means they do it for you automatically. It just means you tell them, hey, every stock that I own that pays a dividend, every time you get the money, buy more shares for me. Now, I might only buy a half a share, right? So, for example, let's say the share price is $100 for, let's say, I don't know, Visa or whatever, and they give you $50, well, I'm only going to get half a share. So in the stock market, now Ameritrade and some of these, you cannot buy a half a share. But if you have dividend reinvestment, then you can get half a share. Now, the people like Robinhood, because you can buy like a quarter or a percentage of a share. But that's part of trading. So that's how you make money. You buy it at $10, goes to $50. Or you keep investment money back from dividends, or you reinvest money. There's lots of ways. So let's look at it very quickly. Number one there is trading. Short-term holdings. Now the problem with short-term is the way they do taxes. Now this is the interesting part. Ready? You have $10. You buy a stock. Goes up to $50. Now if you sell it within 1 year, what the government's going to do is the government's going to say, hey, congratulations. You made $40. Right? You made $40. Sorry, let me find that 40. Oh my God, I'm out of money here. Okay, here we go. 20, 30, 5, 1, 2, 3, 4, 5. Sorry, I didn't bring enough bills with me. All right. Everybody got it. There we go. Now, paid $10. The stock goes way up. You're like, woohoo! I bought NEO at 10. It went up to 50. I'm going to sell it. Now, the problem is, the $40 you made, the government goes, aha, short-term tax. Now, what they're going to do is they're going to tax your money. They're going to take money away from you. Sorry, that's how taxes work. Short-term means this. Whatever your income tax rate is, if you're making a lot of money, your income tax, if it's 30%, they're going to take 30% of your money, right? That's called short-term. It's taxed at your income tax, so it's going to change. But if you hold it for more than 1 year, that's called a long-term holdings. So if you sold it at 10 and you made 50, right now, long-term gains, I think, is about, let's see, when I was in Hawaii, it was like 6% Hawaii took, and I think it's 14 or 15 the federal government took. So they took 20% of my 40, right? Okay? So let's just say you made $10, okay? So on a short-term capital gains, they took $2 back. So they took it back because you made money. That's how the government works, right? Now, if I was paying income tax, I would probably be more like 30%. So then I'd have to give them $3 back. So it makes sense to hold your things longer if you want to. If you're trading in and out, buying and selling, just pay the gain, right? Pay the tax and don't worry about it. Now, there's also buy and do your homework. I believe in this. So investing. Why do you sell a stock? You sell it for a reason. I need money. I made $40. I need money. I bought 10 shares. I can make $400. I can take my money and I can buy myself a new computer game or whatever you need, right? So that's one reason to sell. Now, you can take a profit. We call that. Now, if your reason for buying the shares have changed, like I really liked Apple because they did this, and I like cell phones. Now they're talking about, oh my God, they're going to start making cars. I don't like electric cars. You can sell a stock if you think that they're changing why you bought it. So if you bought it for one reason and then they do something else, you can sell it. Now, this one over here that says bad management. Let me see if I can come up over here. Bad management. Management starts to struggle. Baby, I tell you, sell the stock. They have financial difficulties. You probably want to sell, right? Or if there's a better investment somewhere else. Maybe you made a lot of money in one stock and you want to buy some Tesla and it went down. You're like, woohoo, I want to go to this one. It's a better deal. then you can sell your stock. If not, I like the slow and steady. That's how most of my money is made. We also call it dollar cost averaging. So what you would do is something like this. Let me take my little bills here. Let's say the stock is $100 now, but you don't want to buy it at $100. You want to buy it at, let's say, I don't know, $80. So you can put a bid at $80. The stock goes down to $80 and you buy 10 shares. Let's say it starts going down a little more and you buy more. Then it goes up to $90 and you buy a little more. Sometimes, instead of just buying it all at one time, sometimes it helps to buy it over time and then sell it over time. We call that dollar cost averaging, because if you say want it at 100 and you get it at 95, 99, and 102, you average those out and you're getting it at $95. So we call that dollar cost averaging. That's how you can make money. You can trade it. You can buy it for the long term. You can do drips. You can do your investment and find, like, where am I going to research and get a hot stock. So there's lots of ways to make money in stocks. You can also lose money. Usually emotional investing makes you lose money. You get emotional and you freak out, okay? So try to keep your cool, people. All right. So now let's look at the next one, which is, where are the risks? Okay. First of all, stocks can go to zero. And in 2000, when I first started investing in the late 90s and early 2000, we had this .com craze. And so you had these crazy little stocks like pet.com, and you can buy scissorsonline.com, and it went up to like $50, and then a year later it's down to like 0 or 10 cents. Yes, they can go to 0. So what do you do? Well, first of all, sell your losers, not your winners. A lot of people have this problem where their losers are going down and their winners are making money. So yeah, I'm gonna sell my winner, make my $100, and then my loser, hopefully one day it'll go back up again. A lot of times the losers, when they go down for a reason, and they stay down. So, you know, if you have some losers, and if I'm gonna sell something, if I really need money, I might sell some of my winners. I like to get rid of some of my losers. If I had them for 3 or 4 years, or I waited for a year or two for them to go up, I would sell them, okay? Unless they're paying me a dividend, then you might want to keep them because they're paying you money to wait, okay? But that's a good idea. Sell your losers, not your winner. Now, set your amount you are willing to lose, okay? So if you only have $100 to invest, and you're like, you know what? I can afford to lose $20, but I cannot afford to lose all of it. We call that a stop loss. You go up there and you say, okay, I bought the Kirkland Water Company or whatever at 100, and I don't want to lose too much money, so I'm going to sell it when it gets 80. And I can buy it all the way down to, say, 75. We call that a stop loss. So anywhere between 75 and 80, or 80 and 85, you set a little area, so if it goes down, you can sell it. That's one way, okay? Stop loss order. So let's say you buy NEO at $50 and you're willing to lose 20%. You would put a sell order at $40, okay? Then again, sometimes stocks go up and down if they're tech plays like this. So 20% may or may not be a big thing. Sometimes in one day they'll do that. But if you buy the slow or the big companies, it's pretty safe to say I can lose 20%, sell it off. They don't usually go up and down as much, but it's one way to do it. Now, the second area of losing money is called opportunity cost. Basically, it's like this. There's a good opportunity to buy it somewhere else. If your money is tied up in a stock, okay, then you're lost, right? So opportunity cost means this. And you look right here, it talks about high interest credit cards. So let me swing over here and let's just grab a little portfolio of credit cards here. Okay, so let's say I have a credit card and I have a balance. And if the interest is like most of you 12 or 18%, that means when you got $100 in there, they're charging you 18%, but every time, every day they're taking out the percentage. It goes up and up every day. So don't let that 18% per year fool you, because it's compounded. They're not waiting till the end of the year and asking you for $18. Every month they take a percentage of it and they add it. So your balance keeps going higher and higher if you pay off the minimum, or it goes down just a little bit and you lose money. So if you have high paying credit cards or something, get rid of those first. Because if you're paying 18% or 28% or whatever it is, how are you going to make 18% in the stock market? You might do it if it's a hot market, but by and large, probably not. So pay off those. If you buy a house, maybe you could have high rent, or high rent, or buy a house. You could do other things to make money first. So look at your money that's going out and what are you paying in interest and other penalties, right? We call that opportunity cost. Or if you have $500 tied up in a stock like, I don't know, Rolls-Royce or Boeing or American Airlines or something that's really struggling, and then there's this hot stock that keeps going up that you like, maybe you should sell that one stock that's doing bad now and then buy the one going up. The other way is, maybe your stock's really high and you're doing pretty good, but there's another stock you really like and you think, man, this one's a better deal. Opportunity cost. You have no money because money's here. It's in your credit cards. So you opportunity to buy elsewhere, you can't do it because you're tied up in something else. We call that opportunity cost. And basically, using borrowed money called a margin. That means if you're going to invest, please don't use borrowed money unless you're like a trader and you're doing puts and calls and these kind of things, stop loss orders. Don't use borrowed money. We call that margins, okay? So, put in a stop loss, maybe opportunity cost, you can buy somewhere else, and be careful not to use borrowed money. Your investing money should be money not stealing from your parents or your children or borrowing money on a credit card to buy stocks. Now, this is a very dangerous game because the stock market isn't like owning a property or owning something you can physically hold on to. It's similar, but it's dependent on other people to maintain it and to keep that equity. If you have your house, you maintain the house and you keep control of it. So it's a little different. So what we're going to do now is just find us up here in what is a stock, why buy a stock, how do I make money in stock, and what are the risks. So thanks for staying with me here. I believe in being partially owned in the stock market and buy some bonds and buy some gold. Get yourself a property somewhere and try to diversify your portfolio. Don't just buy stocks. You can if you want, and people have made money that way, but don't be deceived by all the get rich quick and, ooh, I made all this money. And look at all these people that did these crazy GameStop bets and they made $1 billion. Do not believe them. They're very few and far in between. It is a myth. Most people that try to get easy money will usually lose it. And as they say, bears can make money. So if you're pessimistic, you can make money at betting stocks going down. Bulls make money. If you're like, woohoo, I love this and I'm investing and I'm doing good and I'm researching, they can make money. But hogs or pigs get slaughtered. Meaning if you get too greedy and you're like, ooh, I'm going to put all my money in this one little stock because it's doing really great. Trust me, it might not be doing really great after you take all your money and put it in there. Okay? So have a good day. I will see you at Ideas for Better Living or join us at onemeandream.com.